Navigating the world of cross-border inventory accounting can feel like trying to walk a tightrope while juggling flaming torches. It's a complex dance of numbers, regulations, and standards that can leave even the most seasoned finance professionals scratching their heads. So let's break it down in a way that's relatable, engaging, and most importantly, informative. Imagine you're the finance manager of a company that has its fingers in multiple pies. Maybe you've got warehouses in the US, distribution centers in Europe, and retail outlets in Asia. Each of these locations has its own set of rules, regulations, and accounting standards. You're not just dealing with one set of books, you're managing a whole library of them. That's where the challenges of differing accounting standards come into play. You see, the two giants in the accounting world are the International Financial Reporting Standards, or IFRS, and the Generally Accepted Accounting Principles, known as GAAP, which is primarily used in the United States. While there have been efforts to bring these standards closer together, significant differences still exist. For instance, under IFRS, you can use methods like FIFO, first in, first out, or the weighted average cost method for valuing your inventory. But if you're operating under GAAP, you might opt for LIFO, last in, first out. That's a big deal because the method you choose can dramatically affect your financial statements and tax liabilities. And let's not forget about local standards. Take China, for example. They have their own set of rules called the Chinese Accounting Standards, which can differ from both IFRS and GAAP. So, if you're a multinational company, you're not just dancing to one tune. You're trying to harmonize a whole orchestra of accounting practices. It's like trying to play a symphony with each musician reading from a different sheet of music. But the challenges don't stop there. We also have to consider tax requirements, which can vary just as wildly as accounting standards. Each country has its own tax laws that can impact how you report your inventory for tax purposes. Some may require you to use a specific valuation method, regardless of what you use for your financial reports. Others might have different rules about what costs can be included in inventory calculations. It's a minefield, and if that's not enough, there's the issue of transfer pricing. This is all about how you set prices for goods and services between your different entities in various countries. You have to ensure that these prices are set at arm's length, meaning they should be the same as if the entities were unrelated. Otherwise, you could run into compliance issues that could cost your company dearly. So, how do we manage all this complexity? First off, one effective strategy is to harmonize accounting policies wherever possible. This means finding common ground among the different standards and developing a consistent approach. For example, you might decide to use the FIFO method across all your entities, even if some allow for LIFO. This simplifies your accounting process and reduces the chances of errors. But let's be real. Sometimes local regulations are so different that you have to maintain separate policies. It's a balancing act, and it requires careful planning. Next, implementing robust inventory management systems is crucial. You need a system that can track inventory movements, costs, and valuations in real time. Imagine having a dashboard that gives you instant visibility into your inventory position across all locations. This not only helps with accuracy, but also allows for seamless data flow between your inventory management and accounting systems. The goal is to reduce discrepancies and ensure that your financial reports reflect the true state of your inventory. Regular inventory audits and reconciliations are also vital. Think of it as a health check for your inventory. You should conduct these audits at least annually, if not more frequently, especially if your inventory turnover is high. This involves physically counting your inventory and verifying the costs and quantities. It's a bit of grunt work, but it pays off by ensuring that your financial statements are accurate. Staying up to date with regulatory changes is another key strategy. Regulations are constantly evolving, and you need to keep your finger on the pulse. This means having dedicated teams or resources to monitor changes in each jurisdiction where you operate. Engaging with local tax authorities and accounting firms can also provide valuable insights and help you navigate any tricky waters. And let's not forget about training and support for local teams. Your local finance teams are on the front lines, and they need to be well-versed in your inventory accounting policies and systems. Providing them with the right training and resources ensures that everyone is on the same page. It fosters a culture of communication and knowledge sharing, which can help identify best practices and resolve issues quickly. Now, you might be wondering, what's in it for me? Well, effective cross-border inventory accounting isn't just about compliance, it's a strategic advantage. When you manage your inventory valuations accurately, you minimize the risk of penalties and legal issues. You improve financial reporting accuracy, which provides stakeholders with a clear view of your inventory position. Plus, you can optimize inventory levels and costs, leading to better profitability. But perhaps most importantly, having accurate and timely inventory data allows for better informed business decisions. Whether it's setting prices, planning production, or allocating capital, you need reliable data to guide your choices. It enhances your operational efficiency and agility, allowing you to adapt quickly to changes in the market. In conclusion, while managing inventory valuations across multiple jurisdictions is undeniably complex, it's a challenge that can be tackled with the right strategies and practices. By harmonizing accounting policies, implementing robust inventory management systems, conducting regular audits, staying updated on regulations, and providing support to local teams, you can navigate this intricate landscape with confidence. So, the next time you find yourself juggling the demands of cross-border inventory accounting, remember that you're not alone. It's a shared experience among many companies in today's globalized business environment. Embrace the challenge, and you just might find that effective cross-border inventory accounting becomes one of your organization's greatest strengths.